Well, Victor, I'm excited to sit down and talk to you today because we have a very exciting podcast topic. The Fed is once again on the move, cutting rates and really starting a whole new rate cutting cycle.
Yeah, I mean, for the first time in a year, it's pretty wild to think that this time last year, last September, we were in a spot where the Fed had just cut 50 bips. You were heading into an election. You were thinking, hey, inflation's on a downward trajectory. We're going to have rate cuts in 2025. And we just now got another rate cut for the first time since then. And so it's been this anticipation building of when we are going to get this rate cut. And of course, it was relatively modest. It was 25 basis points or 0.25%. Which brought that key Fed funds target rate down to the 4% to 4.25% range. So investors have really been anticipating this rate cut for quite some time now. But the fact that we got it, I think, is really fascinating, and it leads us into the conversation today, where we want to talk about why did the Fed cut rates? Where's the trajectory of rate cuts going and what to expect, from here on out? And then, of course, most importantly, what you as an investor should expect, given the rate cutting cycle that's about to be upon us and what that means for equities, bonds, and other assets.
And I think the viewers are going to see a lot of parallels with what we were talking about, a year ago, which feels like much more than a year ago. It's kind of hard to believe. But a lot of parallels with what we were expecting out of that beginning of the rate cutting cycle, because a lot of these things are kind of timeless lessons, but also so much has changed in that past year that I think there's a lot of new stuff to talk about, unpack, changes in economic data. We're not in the same place that we were a year ago. And so, there's a lot of new stuff that's, I think, really interesting to this conversation. So like you said, they cut a quarter point or 25 basis points, bringing the Fed funds rate from that 4.5 to 4.25 down 25 bips to 4% to 4.25. With the ranges, it's kind of difficult to call that out, but everything just shifted down 25 basis points. Perhaps the most exciting part of it, though, was the updated summary of economic projections. So that, also referred to as the SEP, is released every other Fed meeting. And so that's where we get the dot plot, the infamous dot plot, and what shows everyone's projections for rate policy going forward, end of the year 25, end of the year 26, and further on than that. And so that showed, a lot of interesting things there, because we have a bunch of individual points. It's not just one consensus median point. A lot of times people will quote the median projection, but here there's a lot of spread between those dots, because a lot of times, it's fairly short range. People kind of have an idea of where the push and the pull is, what direction they're moving. And I would say that most of the dots showed a strong directionality, certainly, of lower rates. But the question, obviously, in their minds is, what does that look like? How fast can we really move? Because we had some people looking for many, many rate cuts by the end of next year, and some people looking for only a couple rate cuts by the end of 2026.
Right. And I think that's where it gets interesting. And I'm sure our listeners have seen headlines. I mean, one of the fascinating parts of the summary of economic projections was that you had Stephen Mirren's dot on the dot plot, several cuts below everyone else by the end of this year. His was just above the 3% range, which would mean you're getting another 125 basis points or 1.25% of additional cuts. So a little bit of politics playing into this, which is, leading Wall Street to really think through, hey, what about this new interaction between the federal government and the Federal Reserve, because they are supposed to be separate and independent institutions. But it creates a little bit of a layer of complexity there. And I want to remind our listeners that, whenever the Fed is making a decision like this, it really comes down to their dual mandate. I've repeated this on podcasts before, but I always think it's worth mentioning, is the Fed is looking at two things. And one is price stability. So when you think of price stability, think inflation. They're trying to keep a modest inflation level. And for the Fed, that's a 2% target rate. When we aren't quite there yet, which we'll get into, but it makes this rate cut all the more interesting. And then two is maximum employment. And that's where we get to this rate cut, because the Fed is trying to make sure that everyone in the economy is essentially employed. And by lowering, monetary policy, by making it softer, is more likely to help businesses hire people, fuel the economy, keep everyone employed, and everyone happy, the economy growing and doing well. And so they're really trying to balance those two mandates. But the problem with this cut, or the contention with this cut, I should say, is the fact that we still are above that Fed inflation target. We're running around, let's just call it the 3% mark when it comes to inflation, and their target is really 2%. Now, I think scholars, investors, economists can all argue whether or not 2% is an appropriate target rate, but at least for now, that is the Fed's target inflation rate. And we're not quite there yet. But because of how the labor market has weakened recently, they're slightly concerned about that. They feel like it's worth cutting rates proactively, trying to help out that labor market in order to better stabilize what they see as the more important part of their mandate right now, being that maximum employment piece.
Yeah, and I think it's interesting to focus on that 2% level of inflation, because looking back historically past 40, 50 years or so, we've kind of run around that 2 to 3%, depending on the year. It's been fluctuating a lot. Obviously recessions, COVID, several things disrupting that, but broad strokes, usually within that 2 to 3% range. And so we're not really in a terribly abnormal place right now with inflation. 3%, a little high, but I think a lot of that is trying to get it back down to where we know that we're back in, maybe even a relatively low amount of inflation period, and that inflation is really stamped out, because that's a huge, issue and concern for the Fed, is they call it a victory and then inflation starts ticking back up. And so they really want to target that 2% so they can feel much more secure in that evaluation. However, being back towards historical levels, I think they feel a lot more comfortable reaching out, staying moderately restrictive, without being, overly stimulatory or overly restrictive to where that labor becomes an issue. Because we've been in a really interesting environment for the past maybe 6 months to a year with the labor market. It's been a low unemployment situation, but a low hiring situation. So low hiring, low firing is what people are saying a lot. And the concern with that is that it's not really an issue to the broader economy yet. But if there were layoffs, if people started to reduce headcount, then it'd be really hard for those people to find new jobs. And that's when unemployment could tick up really fast, because there's just no amount of buffer there.
Right. And I think you made a critical point in saying that where we are in the economy right now, we are relatively balanced on the job piece of it, the employment piece, where you aren't having massive layoffs, to your point. You aren't having, huge difficulty for people getting jobs. The problem is, as you said, employers are just not hiring as much, but they also aren't firing as much. So as far as, are there red flags, hitting the economy right now? Are we really worried about that? Not yet. And to your point, the Fed doesn't want to see it degrade into something that is concerning for the economy, that may result in a recession or something like that.
And just to interject an interesting data point that kind of highlights this, interesting dichotomy between hiring and firing, is your unemployment rate for recent college graduates is fairly high. I think it was 6.6% or so. So it is elevated. And that kind of goes to show there aren't a lot of jobs on the market. And for most people, established people in a current job, that's not really an issue. But you're seeing that on the front end of people entering the job market and being relatively unsuccessful finding jobs.
Right. And I think this will certainly be for another podcast, but the dynamics of why the labor market is the way it is, a lot of it can be boiled down to the things that the Fed can impact, monetary policy, how weak or strong, how restrictive or unrestrictive are you from a monetary perspective, but also the influence of AI, of tariffs, of the immigration situation are all things that are playing into this job economy. And we will save that for another podcast, because that's a lot to dive into. And I think there are some really interesting dynamics there, especially when you're talking about AI. But, today at least, I think that the clear answer is, if you're going to ask, why is the Fed cutting rates? It's because of the job market. They're trying to get ahead of it, which I think they're doing a good job by going ahead and cutting rates to help the job and employment situation versus worrying too much about inflation. And so this kind of brings us to where we're headed. And as you mentioned earlier, the Fed released the summary of economic projections. It gives not necessarily a forecast. Certainly Jerome Powell, the head of the Fed, doesn't like to call it a forecast, but it represents where Federal Reserve members see interest rates heading over the rest of the year, over 2026, 2027, and then long-term rates. They also provide things like economic growth expectations via GDP, things like unemployment expectations. And we saw some of that in this most recent SEP. Do you want to kind of go through some pieces of that?
Yeah, I mean, kind of like you said, we saw for end of 2025, you mentioned Mirren's data point, but the median point was for 2 more cuts this year. I think that's a fairly safe, stance to take. We have 2 more Fed meetings this year, 1/4 point cut at each one. Seems about right, assuming data, stays consistent with what we've seen. And 2026 is really where those expectations diverge. Some people, again, mirroring down another cut or 2 in 2026 from already a very low spot. And then the majority, just spread between that and no cuts. Because I think the question mark is on what that future data is going to look like. And once again, Jerome Powell reiterated the stance of being data driven. And I think you can kind of, start with a Fed path, but then once you get beyond the rest of the year, they are really going to have to rely on incoming data because no one really knows what that's going to look like.
Yeah, and I think there's 2 things to consider here in how quickly the Fed is going to cut rates. Is where is the neutral rate, first of all, which I feel like is a little bit more consensus than the how quick part of that. It's probably in the 3%, 3.25% range. So that would be another, call it, 1% from where we are right now, about roughly 4 cuts, 4 or 5 cuts. And then the more important question is how rapidly do you get to that perspective? And so I want to back it up there for a second, for our listeners, and that the neutral rate would be where the Fed expects interest rate policy to be, where they are not restrictive and they are not, unrestrictive. So they're really in a kind of balanced monetary policy perspective where the economy can kind of grow and things are going to be healthy, but you're not tamping down growth where they are right now, trying to lower inflation, really slow growth. You're kind of balancing those 2 parts of the mandate. You want inflation to be moderate. You want the job market to be healthy. Trying to find that balance of monetary policy where you're not being super stimulative, you're not really driving growth in the economy, but you're also not pumping the brakes and slowing things down too much. So I think those are the things that the Fed members are really debating right now is how quickly are we going to cut rates to what that future neutral rate will be.
Yeah, so you could almost say it's the interest rate at which the Fed has a neutral effect on the economy.
Right.
So yeah, and yeah, I think that's going to be a combination, like you said, of what inflation's looking like and where the job market is, because they'll definitely cut quicker if the job market looks weak and inflation is good enough. I think there's a concept of good enough that is still out there, maybe a bit less talked about than what we saw last year of do they really need to get it down to 2% or is 2.5% good enough in order to protect the job market? And I want to use the word protect there because it's not about saving it. The job market, kind of like we've been talking about, isn't at a bad point. It's just de-risking it through Fed cuts. And so, is 2.5% inflation good enough to go ahead and take some more pressure off the job market? That's really the question. And we'll see how the data turns out. But really interesting set of factors going on, and it's not always that we get to dive into the macroeconomics in this position, in this job, because a lot of it's looking at company specifics. This is kind of an exciting time to be in this world where we get to look at both company specifics as well as the macro effects.
Right. And then I think, from here, we have to take our own take of where the Fed's headed. We also look at market expectations. Fed funds futures dictate where market sentiment is as far as future rate cuts. And right now, the market's still expecting 2 more cuts this year at the very end of October meeting and the December meeting. And so what I want to get into now is, of course, this is an investing podcast. We want to talk about how this is driving our investment philosophy. What are the pros, cons of this monetary policy, and which assets are going to be impacted? So I think starting off with, some of the pros, obviously, and this is what the Fed is getting at by lowering interest rates, is lower interest rates make lending cheaper for companies predominantly. And that allows them to finance capital projects, hiring, other investments at lower rates. If less of those dollars or fewer of those dollars are heading to debt servicing, more of them can go to capital projects that drive growth, that drive employment, and help fuel the economy. And similarly for the consumer, I think when we all think of, hey, what's the biggest debt item on someone's balance sheet, for a consumer, it's going to be their mortgage most likely if they own a home. Of course, you can also talk about credit card debt and things like that, personal loans, but predominantly it's going to be those mortgage rates that impact the housing market. As mortgage rates come down, that helps free up other dollars to towards discretionary purchasing, to other areas of the economy for the consumer. So it helps drive the economy forward that way as well.
Yeah, I think that's interesting because the consumer does rely a lot more on fixed debt than companies. Corporations, especially the small ones that are borrowing a lot, but really generally are highly reliant on floating rate debt, which is you take the Fed funds rate plus a certain spread to the lender, and that's your interest rate. So they all immediately got a 25 basis point decrease in their rate. We haven't seen that in our existing mortgages exactly, but you'll start to see that trickle through, hopefully as the housing market picks up, as people, refinance that debt. Maybe it's other, credit card or student loan debt that is refinanced at a relatively lower rate. This 25 basis points doesn't do so much for the consumer, but definitely as rates continue to come down, and really watching the 10-year rate for mortgages, because a lot of times people think mortgages are based on 30-year rate because they're generally 30-year mortgages in the U.S. However, people move. People don't keep their homes for 30 years generally. Right. So really the 10-year is much more indicative of what mortgage rates are going to be. So a little fun fact there. But, as we watch that 10-year come down, that will have a more direct impact on the consumer. But still, to your point, it's going to be good for both businesses and consumers, as well as just, broader economy. All that, those two really make up the economy in the U.S. And historically, when we're in a market environment like this, S&P's at all-time highs, just broad markets are at all-time highs. Rate cuts have strengthened the market. It's led to further growth in the markets. And, I think that's a really important thing to keep in mind, because there are kind of like we've mentioned, 2 ways of cutting rates, 2 reasons you cut rates: because you're in trouble, or because you've kind of fixed the issue and you can get back to regularly scheduled programming, And so I think whenever you're in a situation of strength, it's really good for the markets. When you're in a position of weakness, it can have, more mixed effects.
Yeah, I think you made an excellent point there, because I feel like normally when we're thinking about interest rate cuts, it's because something has broken in the economy, things are bad, you're in a recession, and you need to ease monetary policy so that you can ramp up that business activity. It's really the opposite here, and you made a great point, is that you want to see where you are in reference to that neutral rate. So if you're above the neutral rate where we are right now, restrictive, you're just returning to that stance. In a situation like a recession, you probably were at that neutral rate, and then something went wrong, and so you have to go below it. And so in this case, when you've had the market at all-time highs, but you're cutting rates going into that, it's usually led to really good market outcomes over the subsequent 12 months. for a lot of the things that we've outlined here, because you're adding, more fuel to the fire, if you will. You're making debt cheaper. You're allowing more dollars to flow throughout the economy, stirring up business activity, improving the economy, and then, leading to greater earnings for corporations, which should help propel the market forward. As long as we don't see some kind of serious, to your point earlier, some serious degradation in the labor market or in the economy, then this rate cutting cycle should be a healthy thing that leads to higher highs for stocks and equities. And I want to get into some of those, more dynamics as we move forward, but especially for your interest rate sensitive sectors, thinking, home building, obviously the housing market is highly impacted by interest rates, should benefit them, should benefit a lot of financials companies that are working on, on interest rate spreads, if they can finance at lower rates, but lend out, at maybe slightly lower rates, but still bigger spreads than they were before. That's going to benefit them. And then, other things like small cap stocks and mid cap stocks who use more debt to finance their operations. That removes the burden from them, especially if you're talking about in private markets where a lot of small, kind of medium-sized companies use a significant amount of debt and they're borrowing at higher interest rates than your big corporations are. It should be really beneficial to them.
Yeah. And, I think that's great and all to look at all the pros, because there are a lot of pros, and it's, I think, going to be a net positive thing for the economy. Like we were saying, we're in what I generally refer to as that position of strength right now, cutting. And so I think that's returning market back to normal is going to be a great thing for the economy. There are a few areas or, certain things that will lose out, of course, because it's economics, and that's always kind of how it goes. There's no one secret thing. Otherwise, we'd all be in negative interest rates right now. And, one of the things that I think is both a pro and a con is the reduction in money market rates. So that's, savings deposits, that's, money markets in your traditional brokerage accounts. That will, automatically, immediately decrease by 25 basis points. And we've been around 4% in those money markets. And so now you're probably in the high threes right now. And, that all of a sudden starts to become a much less appealing place to be, because that yield is just eroding, and it will continue to erode as the Fed cuts. I think that's a pro and a con, because on the con side, it's essentially government guaranteed money. It's treasury bills and, essentially similar items. Right. But on the pro side of it is all of that money is, not all of it, but a large portion of it will go in search of more yield to find a new home, whether that's higher yielding debt instruments, bonds, preferreds, whatever that may be, or moved into equities to find that higher return now that the safe, easy return is off the table.
Right. So, yeah, just to kind of summarize what you just said there, your yield that you're going to get, and whether it's your bank account or your brokerage account just on cash, it's going to go down. We've already seen it go down in money markets. It pretty much goes directly with the Fed funds cut of 25 basis points, 0.25%. But on the opposite side of that con is the fact that it's flowing into other assets, which could be beneficial if you are a stock investor or if you're a bond investor, because people are looking for yields and they may extend duration, investing in those longer term treasuries, corporate bonds, things like that are going to seek out that higher yield. It'll also, because of the supply and demand dynamic, more demand should increase the price on those assets. Now, whenever I think of another con, and it's something that we've seen so far this year for kind of a multitude of factors, but whenever you have a sovereign interest rate decrease, it typically means that fewer people are going to buy your debt because it's not as attractive, it's yielding lower. So a risk there would be if U.S. government treasuries are all of a sudden yielding less, then foreign investors, or even domestic investors for that matter, may demand fewer dollars because they are not investing as much as they were before, which could lead to dollar weakness. And of course, dollar weakness has a lot of dynamics involved with that. And we've kind of talked about this on previous podcasts as well. But it means that U.S. corporations, if the dollar's weaker, they can't buy as much from foreign countries. They can't afford to do that, or it becomes relatively more expensive for them to do that, which can hurt some areas of economic growth, particularly in kind of manufacturing, industrial sector, where you are sourcing a lot of goods and materials from overseas. Of course, with the whole tariff situation, that dynamic has already been shaken up to a large extent. But I think it's worth noting that it can impact dollar strength if you are going to lower interest rates.
Yeah, and that kind of gets back to what I was saying earlier with it being a very interesting time in this job because there are so many things moving right now, and the dollar has already depreciated a bunch this year so far. Granted, that's coming off of a position of relative strength. The dollar was, at the end of last year, almost at parity with the euro. A little while before that, it was past parity. So coming off that position of strength, because the Eurozone has already essentially done their cuts and they're starting to pause, and now we're cutting. So obviously it's going to move one way or the other. Now we're moving back. But like you said, a conversation for another time. But kind of back to my first point on the con section is there's a reason we're not all at negative interest rates is because at a certain point, it goes back to economics. And if, a con of it could be that it takes pressure off of inflation. And if inflation becomes a problem again, start the whole process over. And no one really wants that. Which, whether or not inflation becomes a problem, it could also, in the more immediate term, give investors some apprehension as to the state of the economy or concerns about, forward-looking prospects. So, a number of ways that can have a negative impact. I don't think that's anything we're really looking at yet. But again, if we got the mirror style cuts of, another 1.25% this year, then people would start, having some apprehension. It's like we were talking about in the office is, between a 25 basis point cut or a 50 basis point cut, which would investors really prefer? And the jury was kind of out on that one because 50 basis points might be, perceived as a little fast, a little much. And investors worry. That's what we do. And so, that kind of activity too far, too fast could drive more apprehension than it would in all of those pros that would come along with it.
Yeah, I mean, exactly to that point, you want to look at what the reason for the rate cuts are. Is it more driven by a weak labor market, in which case that's concerning for the economy, that's concerning for markets? Is it just returning to a neutral rate and all of a sudden you're finding the labor market in balance, inflation's still coming down to some extent? Then everything looks healthy and it's going to be good for equities in the broader market. So I think what we're going to be paying attention to very attunedly over the next 6, 12, 18 months is going to be what is driving those interest rate cuts, because that's going to determine how are we going to invest. Are we going risk on or risk off? Because it's all going to come down to the U.S. economy as far as what's driving the Fed to make their decisions. And that's why they remain data dependent. That's why they're so in tune with what's happening with the data, because hotter inflation could slow down the amount they're cutting. A stronger job market could slow down the amount they're cutting, whereas vice versa, weaker inflation could give them more leeway to cut. A weaker job market could give them more leeway to cut. And there's situations in there where it's positive for the market, situations where it's negative. So we'll be obviously covering this as we continue to go on.
Yeah, and so past the immediate effects, what's the broad strokes of what this is going to do? What are takeaways from all of this?
Yeah, I'd say most importantly, I think we're looking at an environment where I mentioned earlier the statistic, whenever you're cutting rates at all-time market highs, it usually leads to very good results over the subsequent 12 months. So we're still bullish on equities and the stock market. Of course, I already mentioned a couple areas in there. I think also if you're considering the fact that inflation's probably going to remain decently higher, you want something that's going to be a benefit that gets the benefit of the rate cut and slightly inflation as well, which real assets typically have been a really good hedge for inflation. That can be things like, equities are part of that because earnings will kind of work in lockstep with inflation over time. But also things like gold should do well because as rates come down, a non-yielding asset like gold looks relatively more attractive. Inflation also helps gold price go up. A weakening dollar could also help gold's price go up. So I think that as far as alternative assets, you can kind of lump cryptocurrency in there as well. Could be an interesting hedge when it comes to something like that. And I kind of want to frame these things in the realm of a healthy economy because it's going to change if the economy degrades and we have to get more defensive in our positioning. But we haven't seen that come to pass yet. So, but then, the interest rate sensitive sectors, we're more interested in some financials that are going to benefit from increased deal activity. As financing rates get cheaper, more companies are going to get bought and acquired, which means that the companies that facilitate those, investment banks, private equity firms, should benefit. I think you're also going to get, the broader market and the widening out into small and mid caps should see a benefit from that as well because of those lower borrowing rates. So those are some takeaways that I have.
Yeah, I think all of those are really good. I mean, to your point on gold and crypto, that kind of parallels back to the conversation about foreign currencies. It's not only are these things real assets like you're talking about, especially gold, probably more tangible assets at least. But they're essentially alternative currencies. Gold's been used as a currency since the dawn of time, and crypto since the dawn of crypto. But it's diversifying away from the dollar in order to avoid the dollar weakness that generally comes with cuts anyway, as well as just your issues of inflation on the weak economy side, protect yourself from inflation, which makes gold a really interesting place right now, especially in my mind, because it's both like an offensive and defensive kind of position. It's traditionally a very good inflation hedge. It's been very popular since this whole inflation run. But it's also in a great spot for all of the other macro issues that are going on and has appreciated fairly well year to date for a non-yielding asset. And like you said, lower interest rates, lower, debt payments, that makes non-yielding assets relatively more attractive. So that should be another tailwind for gold, which I think is really interesting.
Right. So kind of to wrap us up here, conclude, I think it's all going to come down to the reasons why the Fed is cutting rates. Is it because we're just trying to get back to neutral? We're getting back to that 3.25, maybe slightly sub 3% Fed funds rate? Or is it because something's gone wrong in the economy? And that's where you really have to be active in watching what's going on, because the first scenario is going to really benefit markets, going to lead to higher highs. I think even in the tech space, we've seen the AI momentum, but I think that can continue on, as long as corporations continue to spend the way that they're spending. But, on the alternative side of that coin, I think if rate cuts are coming through because the economy is really weakening, you have to be very, very careful with your positioning in some of these sectors because you want to go a little bit more risk off. There will still be opportunity. There's always opportunity to invest, but you're going to be more defensive, given exactly why the Fed is cutting rates. Right now, base case, everything looks good, but that's why we watch this every single day.
Yeah, exactly. And, to your point, base case that we're in a good spot, we're going to continue going along smoothly. And I think that's a lot of what the Fed is looking at too. Obviously, they're going to hedge their expectations, but looking at, forecast GDP numbers, forecast unemployment, it appears that the Fed is expecting the U.S. economy to continue on a good track. We are too. But like you said, he's just looking out for those pitfalls, why the Fed's staying data dependent and why we're doing the same.
Exactly. And I will say to our listeners, if you've enjoyed this conversation, if you have a question that you'd like to ask specifically about a certain sector, about an asset class, about inflation, about the Fed, drop us a comment on YouTube or go to our website and contact us at beckcapitalmanagement.com. That's why we're here. We love informing our clients, our listeners, and that's what we enjoy doing. So we look forward to covering these topics as time goes on here.
Yeah, exactly. Thanks, Victor.